Let's keep it with the corporate conversations then. The next company on our radar is Metro Brands. Now, the company reported a healthy revenue growth for the fourth quarter. EBITDA has also improved quite a bit. Let's talk about these trends and the outlook with Mr. Nissan Joseph, Chief Executive Officer at Metro Brands. Mr. Joseph, thank you very much for joining in. So really a good quarter. I think you've got 10% revenue growth. There's a significant margin improvement. Margin is up to over 30%, 30.7% EBITDA margin. So let's start by understanding the broad demand structure and trends, because while the fourth quarter has been looking good, if I look at the year as a whole, FY25, I mean, you had guided as much as 12 to 15% growth. Ultimately, the revenue growth was around, I think, 6-7%. How do you gauge demand sentiment, the mind of the consumer right now? And what do you see ahead in FY26? Is it, how will volumes do? Or will you have to eke out revenue growth with some pricing uptick? What's the sense?
Well, Surabhi, good morning, and thank you for having me. I think we were very pleased to see the upturn continue through Q4 of this year. You're right. When you look at the whole year consolidated, it's been a challenging year. We had a lot of absent wedding dates going back to Q1, Q2 that really set us back a little bit. We also had heat waves. We had the election distraction. So there were some headwinds to overcome through the first part of the year. The good news is on the second part of the year, we were able to recover quite well. As you mentioned, we were up 6% on a consolidated basis by the end of the year. But more importantly, I think what we've shown is our ability to have great financial discipline through the year. Though it was a tough year, as you know, that we've posted some very good growth that exceeded our revenue growth in EBITDA that exceeded our revenue growth. And, we came in at the 30% range. We always guided that we would be at the 30% range. While the overall top line growth wasn't what we wanted, I think the recovery was good and we're headed back.
But what now, sir? The question is, what now? You've done 10% revenue growth in the fourth quarter. Do you think you'll build on that in Q1, Q2? What's the kind of top-line expansion we should expect? If you can't give us visibility for the whole year, maybe for the first half, but essentially, is it going to be more volume-led or is it going to be pricing-led?
Well, I think it's going to be both a little bit. We're not raising prices significantly. So any growth you see is actually coming from volume growth in the business. And we're pretty pleased as to how that's trending. We remain committed that we'd get back to the 15% growth rate on an annualized CAGR basis. So I think we have all the indications that we should be headed to that direction. You don't always recover and jump right up to that number. But as you can tell, the indicators the last 2 quarters have been very positive.
Okay, all right. Hi, sir. Morning. Good to see you, Ben. So at least a double-digit growth is what we can work with, right?
I think the indications are all in place, Nigel, that we should be headed in that direction.
Okay.
But more importantly, I think the other numbers that are important to us is the EBITDA and the profit, which we're starting to trend back at the 15% mark, which is we guide to the mid-teens on PAT. And then, of course, the EBITDA, we guide to about the 30% range. And all those metrics are coming in line.
Okay. PAT margins at mid-teens, EBITDA margins at 30%. Got that. Give us a few more details then. What kind of store additions will you be looking at for this year? And if you could help us out with some commentary on e-commerce. That seems to be plateauing a little bit. I think it contributes close to 10-11% of your total mix. Where is that headed?
Yeah, so just talking about store growth, I think we continue to be open and aggressive on opening the right stores at the right profitability. We're not going to open stores for the sake of hitting a number. We're going to open stores as and when they make sense for our portfolio of different brands that we have. Our e-commerce business continues to do well. However, as we all know, you can drive a lot of growth in e-commerce if you want to be discount-led, which we don't want to be discount-led on e-commerce. For the year, e-commerce outpaced our regular growth. We were up 20% in our e-commerce business. So that remains healthy for us, and we like it because it's at a healthy pace that comes where it's brand enhancing, without destroying any brand salience at the same time, is a profitable business for us. So it's one of those balances that you have to do as you want to grow the e-commerce business. You have to decide where you want to lie with that e-commerce machine. And also, we've started exploring quick commerce, and like what all the press has been reading, we find it to be very polar in terms of to the big cities and not as much in the smaller cities. So we continue to explore that as well.
Mr. Joseph, hi. Good morning. So online is about 8%. That channel is about 8% for you?
It's a little north of 10% for us.
Okay, a little north of 10%. Now, in the past, we've spoken about premiumization right, across the board. Is that happening? Because if I look at price-wise sales mix on a quarter-on-quarter basis, maybe quarter-on-quarter is just too. It's kind of it's a little. The data is jerky, but over 3,000 rupee products is about 54% of your sales mix. It was 56% the last year. It's broadly been between 52 and 54% or so. Could you give us some idea about this? How this is likely to trend up?
Sure. We continue to see the premiumization trend, but what you're seeing, and you rightly pointed out, Prashant, is the fact that Q4 is our end of season sale quarter, right? And that's when we use that period of time to clean out any old goods that we have, end of season lines, and that typically mutes your ASPs, right? So what you're seeing, that 2% delta, is really more of a reflection of the business and the cyclical nature of the business, as opposed to anything that's showing a premiumization trend fading off.
Mr. Joseph, can you tell us a little more about the Foot Locker expansion this year? What are you expecting from some of these additions? Fila as well. When does Fila break even? How much will it add to your top line? Some sense from these brands.
Great. So, Surbhi, let me take that one at a time. When you talk about Foot Locker, I must be honest and say that the BIS rules that came in has been a little bit of a deceleration of our growth. We would love to grow more Foot Locker stores, but we wanted to make sure that our brands, our suppliers had settled into the BIS supply chain, which is all new to a lot of people. Now that that's behind us, we will continue to open a few more stores this year. And as we overcome the BIS issues and the factories get certified and or up to speed, we should continue to see that Foot Locker acceleration into the next calendar year as well. On the Fila front, I'm very relieved finally that we've gotten out of cleaning up all the inventory for Fila, and we hope to start the journey of opening stores for Fila later on this year.
Okay, all right. So in terms of break-even timelines, the losses have been coming down. What about break-even and overall contribution from Fila? Can you give us some sense of what you are expecting this year?
Sure. Yeah, it's not a question of contribution, because what we've always said was we're going to take the first couple of years to clean up the brand, number one. Number two, the second phase, which we're in right now, is to reposition the brand. So when you move to repositioning a brand, it is not about a percent of sales. It's about, are you pulling the right levers? Are the right assortments coming into stores? Are they selling well? And we've started launching Fila into our Metro and Mochi stores, and we're starting to see the green shoots come there as we anticipated on the year where we reset the brand, right? So that's going on track. And now we also, the next phase would be to start accelerating the opening of stores, and then also accelerating the amount of Fila that we carry in our Metro Mochi stores as well.
Okay, all right. Just a quick question with regard to Fila, Foot Locker, as well as New Era. How much do they contribute as a percentage of your revenue mix? And say in the next 3 years, how much do they contribute?
Yeah, so I think today that contribution is extremely low, right? It'll be single digits. I think you will see that accelerate simply because it's on a low base. From a growth standpoint, it'll be significant, but it's not like we're not growing our other banners as well, right? So we are growing Metro, Mochi, Crocs, and Walkway. We're growing all the banners. So it's not that it's going to jump up and become a double-digit contributor overnight, not because it would have been underperforming in our mix. It's just that the rest of the mix is not stagnant either.
Okay, all right. So a smaller contribution as of now. But, there's that buyout talk by Dick's Sporting Goods of Foot Locker. Does it change things for you?
It really does not change anything for us in our arrangement and our commitment to growing the Foot Locker brand in India.
Got it. All right. So that's out of the way. And what about Fila? You didn't give us a definitive time by when it turns around. Most of the inventory has got done, that we're sitting on in the third quarter itself. So when does that turn profitable?
It's not a question of timing it on turning around, Nigel. This is the year we reposition the brand, right? So it's a journey. It's not a milestone that you accomplish and say, okay, now we're done. It's a journey. It's going to be a constant journey to build that brand. It'll accelerate as we go through this year, and it'll pick up its own momentum at the pace that we anticipate it to.
Okay,
if you could tell us, because you're promising more store rollouts now, both Foot Locker, Fila, etc. I just want to understand how much money you'll need to put to work as you open more of these stores.
Yeah, so the capex is not cheap, as you know, but the good news is fortunately for us, we have a significant war chest when it comes to cash at hand and cash to invest in growing our business. So that is not the concern. We're more concerned about getting the right locations that sets up the brand to be successful in India at the right metrics financially to ensure that it's not dilutive.
No, we just needed to understand, absolutely, sir, full confidence in your capabilities and your team's capabilities. Just needed to understand that from your cash, what is the total cash level right now? How much is going to be deployed towards these store openings? And then perhaps subsequent quarters, we'll talk about the break-even timelines for those new stores. But just some sense.
Yeah, so, we have a sizable war chest. The number changes every day, but it is in the hundreds of crores that we have at cash at bank. So that's not the issue. And as far as it being a significant dent to that, it's not going to be a significant dent to that, as you can do. A store would take anywhere between 2 to 3 crores to open up between the fit outs and the inventory costs. So, it's not a significant factor that we say, what's it going to do to our cash at bank? And, we continue to generate free cash flow as we go through every quarter.
But how many stores will you open this year? We didn't get that number.
No, and it's because, we're not fixated on opening the number of stores. What we're really fixated on is opening the right stores at the right prices. So we'll open as many stores as we can find in the country with the real estate. As you know, the real estate rents have been rising. So now
I think last year you opened 70. This year, will it be as many, fewer, or more?
It should be more.
It should be more. Got it. At least we got some color on that. And final question, ad spends as a percentage of sales, what is it at? And since you're going to be driving growth, where does this number head to?
Yeah, so right now it runs about 3 to 4% in our company. And I think that's a very good question because I think the time has come for us to take a look at that and see how do we invest in the marketing, in the ad spends to ensure that we continue to solidify our existing brands and also build the brands that we've recently acquired.
Just last question, Mr. Joseph. These 3 brands which my colleagues were asking about, these shoes are made where? They're made in India? They're made outside India?
It's a mixture of where they're produced. So if they're produced outside of India, they're produced at BIS certified factories. But a majority of that is being produced locally now.
More than 50% of these are being made here locally in India. 50%
of Fila and Foot Locker combined, yes.
Got it. Thank you very much for joining us. Good speaking with you, and good luck with your business as we look ahead. Thanks very much. That's Metro Brands. Stocks up about 3% or so. Now,